Steve Brown is the chief executive of the Fortress Fund. Now, those of you who've been following the stock will have seen it shot up, in fact, doubled in price, the share price, in February. But there's a reason for that. It was a reorganization of the capital. And it is a company that is focusing on logistics, which is the hot area in property as far as investors are concerned. Steve, before we go into all of that, a lot of people know Fortress because of its shareholding in the biggest stock listed on the Johannesburg, Nepi Rock Castle, which has done incredibly well in Central and Eastern Europe, sitting now with a market cap of about 85 billion rand. Just by way of a little bit of background, because you've been doing a lot of things, can you just give us the history, how that happened, and indeed where the recent streamlining of your capital base, where those thoughts came from?
Sure. So the group history, really there were two companies. The one was Nepi, which was focused initially in Romania, and Fortress did have a share in that. And then later on was one of the founding investors in another entity called Rock Castle, which focused more on Poland, but had similar shareholders and both stemming really from South African capital bases. So in 2017, they merged to form Nepi Rock Castle, which is the group as we know it today. And we ended up being the largest shareholder with roughly just under 25%, so about a quarter of that business, until the scheme of arrangement earlier this year, where we've swapped some of the Nepi shares for Fortress shares. But Nepi's been an unbelievable story, Alec. It's this year, actually, they just released results, and it was the highest distributable earnings per share they've ever had. So they had a record year last year, low gearing, and really some great tailwinds in that Central and Eastern European retail property market that they participate in.
Around 2/3 of the portfolio is in Poland and Romania. Now, when people from outside of Central and Eastern Europe look at the region, you'd think there wouldn't be a heck of a lot of new investment going in, given what's going on in Ukraine just around the corner. Has that been beneficial to Nepi Rock Castle? We'll talk about Fortress in a moment, but because it's such a big part of your portfolio, it's worth actually understanding that.
I think so. I mean, I think what we saw last year, and I guess the war in Ukraine would have had an impact on that. But really what's happened in the capital markets was driven by the collapse of Credit Suisse and the massive jump in interest rates. So I think that's made capital providers shy away from commercial real estate. And a lot of the big groups, for example, Blackstone from the US, is debt driven. When the debt costs go up and debt is hard to find, I think the capital providers step back. I don't think the war in Ukraine's had that much of a direct impact. Certainly not negative. In fact, the one positive out of that disastrous humanitarian crisis that they have there has been a lot of Ukrainians actually going to Poland. And, as history says, it's always the wealthy that leave first. So a lot of the wealthy Ukrainians have found themselves in Poland. So they've actually had this massive increase in consumer spending. So that's been beneficial for a lot of Nepi's assets there, certainly on the retail side, and to a lesser extent Fortresses on the logistics side. So it hasn't had the kind of negative impact on the fundamental real estate that a lot of people, I think it might have. But perhaps from a perception perspective, a lot of the big capital providers have withdrawn. But have they withdrawn because of the war? Or have they withdrawn just because of the sentiment towards interest rates and commercial real estate? I think it's probably the latter rather than the former.
And as far as Fortress is concerned, this focus that you have now on logistics, in other words, warehouses, that is the hot area of property all over the world. People are worried about office spaces, for instance. Commercial real estate retail is still doing okay. But where did that idea come from to get into warehouses? So
part of the nexus of the Fortress Group, there was a corporate action in around 2015 when Fortress acquired Capital Property Fund. Actually, I used to work at Capital Property Fund, and that was really an industrial-focused fund. And I think the trend at the time as we saw with Prologis and big global businesses like that, was really on logistics and warehousing. We then followed largely in their footsteps and started buying new logistics warehouses. Unfortunately, we couldn't find enough stock and we couldn't find the quality we were looking for. So that led us down the next road of, well, if you can't find what you're looking for, why don't we go and build it? And we then started to become more of a logistics warehouse developer, buying bigger tracts of land and building these warehouses so that we could get access to the stock. And I think that morphed into quite a big portfolio. Around about 4 years ago, we had 1 million square meters of development pipeline, which was quite daunting. And as of last year, we whittled that down to 230,000 square meters remaining, and have now started to look for additional pipeline to add to that. But, we don't want to go out and buy these big tracts of land. That sort of is a bit of a heavy load to carry on our balance sheet. So we've tried to do that with options alongside our partners. But that's really how we got into it. It was just looking at global trends and what was happening in the US. And Prologis is certainly a company that we admire, and we often take a few feathers out of their cap and try and emulate what they're doing on the global stage back here in SA.
What areas or what developments that you've done would people consuming this content know? In other words, would you just outline a couple of your major centers?
Sure. So on the logistics side in KZN, we bought the old Clarewood Racecourse and developed that into a premium logistics park that is just along the M4, slightly north of the old Durban airport, if people know that, and not too far from the Durban port. The other big one we had was Eastport Logistics Park. Last year, we finished the largest single-phase distribution center for Pick n Pay, 164,000 square meters. Actually, in that logistics park is Africa's largest data center. We didn't develop it ourselves. We sold a portion of that land within the boundaries of the park to a company called Terraco, who are developing Africa's largest data center and have now requested more land from us to make it 3 times the size. So I would imagine if it's currently the biggest times 3, it will still remain the biggest. And then we've got Clipper and Crusader Logistics also at that park. If you're driving north on the R21, just past our Tambo, you'll see it on the right-hand side. And I think that R21 expressway has really, become a new north-south corridor, and it's really a hot area for logistics, not only in Gauteng, but I think for the whole country. So those really have been a lot of the, our 2 sort of premium parks. And we did a distribution center for Siplamed around 7 years ago in Cape Town, and they've just renewed for another 10 years, which I think, is testament to the quality that we build, that Sipla are happy for their main South African distribution center to be located in one of our warehouses.
The rational mind likes to read the facts rather than the narrative. The narrative in South Africa is very poor. The facts, though, and looking at your interim results to the end of December, seem to be telling us a different story. The like-for-like growth that you've achieved or were reporting on both your retail side, in other words, shopping side, and on logistics or the warehouses side, has been incredibly impressive. What are we to read from this, from what is actually happening in the South African economy relative to the news flow?
Yeah, I like that, Alec. We often say at our office, we've got facts and then we've got feelings, and we may all feel a bit down in the dumps with the problems with Eskom, and this morning we hear problems with Rand Water. But as you say, the facts as we sit here today don't necessarily paint too bad a picture in our core portfolios. Really what the driver was of the like-for-like growth in logistics of 9.2 in our SA portfolio was a drop in vacancy. With tighter capital markets and with less positive sentiment around, the developers have been building less warehouses and certainly less on spec. So I think that's placed us in a prime position. Fortunately, during COVID, we didn't take our foot off the gas on developments, and we just kept building and building. And what's happened in the last couple of years is inflation's come back. So I think inflation's come back, interest rates are higher, so that makes asking rentals quite a lot higher. And that's pulling some of the rentals in our existing portfolio up to market, which is good, so that we can see in the rental growth coming through, and we're getting less negative reversions than we had in the past. So that's very positive for our standing portfolio. On the other side, our retail portfolio, we've seen just under 7% turnover growth. That's how much turnover our tenants are doing in our retail stores. And that's positive. That hasn't translated exactly into NOI growth. There's been some, I guess, in banking terms, negative jaws. In other words, the costs have grown a little bit in excess of what we've seen on the top line. And that was really repairs and maintenance and insurance cost. I think the insurance cost has spiked a lot globally for commercial real estate, and in particular in South Africa, stemming from the riots we saw in 2021. And a lot of that cost is on, SASRIA type policies, some of which we have to go and reinsure in the London market, which comes at an expense. But you're absolutely right. As we sit here today, our business is still in pretty solid health. And I think companies are still looking for prime logistics sites. They want the security of a park. They want new assets which are operationally more efficient. And I think they still are moving out of, for example, 2 10,000 square meter warehouses into 120, or 4 5s into a 20, and consolidating, not necessarily taking more space overall, but consolidating into more efficient space. And then definitely the e-commerce side of things, we're seeing that is a marginal take-up of space. In other words, take a lot the third-party logistics providers who provide the backbone to the e-commerce giants, as well as local retailers who have an e-commerce strategy, and they need the warehousing and operational facilities to roll that strategy out. So that's been beneficial. Our retail portfolio is also very defensive. We've got mostly the nationals. It's ShopRite, Boxer, Ackermans, Pep, really the daily essentials. And I think, even if the consumer's under pressure, they'll cut out fashion and nice to haves, but, you still need your pharmaceuticals, your groceries, and your baby clothes and your nappies. And that's really what we try and provide in a retail center.
There's kind of well known in economic terms that you should be investing, especially in long-term assets, when the markets are down, which you did during COVID. But not too many people are able to translate that. Many boards get fearful. They put projects on hold. What was it about Fortress that got you guys to, as you say, keep your foot on the pedal, even though things looked pretty bleak at one point during COVID?
Sure. I think it was a tough time for all landlords, with tenants not looking forward to paying the rent or trying to defer the rent, and in the retail centers, not a lot of people visiting. I think it was, I would love to say it was hindsight, clarity of thought, or a crystal ball, but really we were halfway through it. We had the land. Some of these developments had been planned, and really where we see people in the real estate game lose their shirts is when they stop. That's when there's true value destruction, because if you have land, you can resell it. But if you're halfway into a building, you have to finish it. That's the best way of getting a return. And fortunately, we did that. And luckily, we had the support of the board and the support of many of our shareholders to carry on and go and do that. And we had the capital. And I think if we had not had the capital and we had been forced to stop, that's when we would have seen true value destruction. But we didn't. We also in COVID took advantage of some wobbles in the market, and we bought some assets in Poland and Romania and embarked on a direct logistics strategy in Poland and Romania, which has also been relatively successful, although it's quite small. I think we see some really positive tailwinds in that market, and that's really evidenced also by how well Nepi's doing, albeit in a different segment. I think those markets are really poised for growth, and we've seen the political step change in Poland and the unlocking of those EU funds. I think 60 billion in COVID relief, 138 billion euros over the next 4 or 5 years in grants and low interest loans. That's incredible. If you just look at what they've got in COVID relief funds in South African terms, that's the entire amount of Eskom debt that has been provided by the EU. It really is a game changer for those countries to be to be inside the EU and that collaborative effort. Everybody likes to, throw a bit of mud at the EU and their, kind of their bureaucracy and how slow they are to move. But when you look at that Central and Eastern European region, they've been hugely beneficial being part of the EU.
And the split between the two now, just to clarify that, how much of your portfolio is in Central and Eastern Europe when you add Nepi together with your direct investments?
At the moment, we've got about 40% of our assets in Central and Eastern Europe.
So that's a big rand hedge.
It is. And what also we took advantage of, or I guess we're more scared of in COVID, was the currency. So we had these cross-currency interest rate swaps, which took a lot of, there was a time and a place for them, but they took a lot of the rand hedge out of that investment, but gave you slightly higher yield. So we closed that. So we have been quite actively trying to get more of our exposure into euros. And I think that's been beneficial. I guess the one thing that you really don't want to do is take a rand hedge and then you go and, destroy value on that side by doing silly deals. And we've been quite disciplined, making sure that it's small incremental steps. So we've built a team in Warsaw. We own all of our assets 100%, and we have 100% of the team. So we don't do a lot of JVs or anything like that. So I think, that control and that market insight does give us a nice platform for growth. So we need to do it, but we'll do it slowly and carefully. And if the market changes, there are no sacred cows. We're not afraid to just sell and, find something else to do with that capital.
And just so that we fully understand that, how long has the greater group, and I'm including Nepi Rock Castle here, been operating in Eastern Europe? Just to show to give us an idea
about 18 years,
how much,
Alec. I think Nepi really got going 2005, 2006, around about there, yeah.
So you're not going in there like into a new market. You've got local knowledge.
We do, and it's great having that exposure through Nepi. It's also, I think we learn a lot. We have a board position there, so it's certainly a market that we understand, we're familiar with, and I think the quicker you can get a team on the ground, as we have done in Warsaw, the better for that. We're very afraid of, I guess they used to call it suitcase banking or suitcase investing, where you fly over there with a suitcase full of cash and give it to the first person you meet at the airport and say, here you go, let's roll out. So we haven't done that. Do I wish we had made it bigger in 2020 and COVID when there was a lot of transactions and deals around? Yes, but at the same time, everybody was scared of the future and we didn't have that much capital. Unfortunately, when you're dividing your rands by 20.5 at the moment, you don't get a lot of euros at the end of it, and they're big players there. So we're quite small, and I think in time it would be nice to get some capital alongside us and act as a sort of an anchor investor, but acknowledge that maybe we don't have the resources to make that a huge business that can compete head on with the likes of Panettone, Prologis, CTP and Segro.
It's an exciting story, Steve, and thanks for sharing with us. And as we close off, I'd really like to get my own head around this, and by extension, the heads of investors. You've got a portfolio in South Africa, partly in logistics and partly in defensive retail, as you've said. You also have your stake in Nepi Rock Castle, plus you've got a small portfolio in Central and Eastern Europe. Just break those down for us and tell us how that relates to your market cap. In other words, when you're buying a share in Fortress Fund today, what are you actually getting in by way of assets, say, for each rand that you're investing?
Sure. So at the moment, we have 34 billion rand of direct property. That includes our 10 billion of retail, 20 billion of logistics, and then about 4 billion of non-core assets, which is a industrial portfolio and a few offices, which we're in the process of selling. So you get 34 billion of direct assets. That has 19 billion of debt. The debt's held at the listed company level, but let's take 34 billion minus the 19 billion of total debt. That gets you 15 billion of NAV. as we sit here today, we have roughly 14 billion of value in Nepi shares. That gets you 29 billion of NAV. And if you buy a Fortress share today, you pay roughly, I think, about 17 billion for that 29 billion of NAV. So it is at a deep discount to its net asset value. I guess if you look at the sector as a whole, people might say, but the whole sector is at a roughly 30-35% discount to NAV. Why should you be different? Because we are different, because 14 billion of our assets is in, as you said, a top 40 listed company with a market cap close to 90 billion. So I think that aspect should not attract a discount. So then if you say, well, let's strip that out, what's left? Well, we would call that the rump is left. So that's the 34 billion of direct assets minus the 19 billion, which is 15 billion. And the market prices that at about 4.5. To pay 4.5 by buying the share to access 15 billion of NAV, I think to me, it looks like a fantastic buying opportunity. And I do think that as long as we focused on unlocking that value over the medium term, which we certainly are, and this single share structure gives us now, finally, the ability to do that, I think we're aligned with what shareholders want. And I don't think we need to sit on, this diversified, balanced portfolio forever. We've been big proponents of specialization and focus. So hopefully the market will realize that and reward us in a higher share price. But if they don't, then it's like a Black Friday sale every day.
Indeed it is. And as Warren Buffett says, try to buy $1 worth of value for in this case, a nickel, 25 cents. You really are looking at the right kind of investment for a long-term investor. And what I particularly like about this is the focus on warehousing, on logistics, because that's an area that the whole world has now understood is always going to be the better place to put your money when it's compared with more volatile other real estate assets. Steve Brown is the Chief Executive of Fortress Fund. I'm Alec Hogg from BizNews.com.